We're going to talk about how proper accounting could save you from losing money. Felix, good morning.
Hi, good morning to you.
How are you doing?
I'm doing okay.
So good to have you back.
It's good to be here.
Umetupotelea sana.
No, I'm back now.
Karibu.
I'm back. Thank you so much. This is always a pleasure to be here.
Yeah.
Yes.
Good. It's good to have you as well. Let's look at accounting. When we say proper accounting, wanasemanga how proper accounting can save you from losing money. To begin, could you explain what proper accounting really means in a business context or personal finance context?
Okay, thank you. That's really a good question
Yeah.
that some people don't get to understand. So I think basically before we start talking about what proper accounting entails,
Yeah.
it's good first to understand what accounting means. So accounting basically means three things, and that's recording, classifying,
Yeah.
and summarizing. So first you record your transaction, then after you've recorded your transaction, you classify your transactions. So by classifying, then it means that if it's expense, you've categorized it into capital expenditure or revenue expenditure.
Yeah.
Capital expenditure are those expenditure that now will go to your balance sheet, the capital. Like if you've bought assets, that's what you call the capital expenditure.
Yeah.
And then the revenue expenditure, what people like to call operating expenses,
Yeah.
or OPEX. And then after you've recorded, so the first step in accounting is recording the transaction. The second step is classifying them. And then once you've classified them, then you summarize them. So when you're summarizing them, you summarize them into the financial statements that I think we spoke about a couple of months back in this show.
Yeah.
We said that you can have the profit and loss or income statement. You can have the balance sheet. You can have the cash flow statement, and you can have the statement of changes in equity. So basically, that's what accounting entails.
Yeah.
The first step is recording, then classifying, then summarizing.
So in a personal context, how would this look like when I'm trying to ensure that I'm getting my money right?
Yes,
I'm putting things in order financially so that I may not lose money.
correct.
Yes. How would it look like in a personal context?
In a personal concept, basically it means that let's say now we split it into your personal money
Yeah.
and your business money. You see now accounting will mainly work if you're a business owner, especially a small business owner who thinks that accounting is for big corporation. So for a business perspective, accounting means that you are recording every transaction,
Yeah.
be it a sale, be it a purchase, be it big, be it small.
Yeah.
That's what it looks like. And then now when you're recording it, where you're getting this information from, you're getting it from the receipts and the invoices.
Yeah.
So if you're buying something, you're being given a receipt. There are those business owners that due to the nature of your businesses, you cannot have a receipt.
Yeah.
Maybe you are a fruit vendor, you buy your goods from the market people will not give you a receipt.
Yeah.
So if they're not giving you a receipt, it's easy for you to forget how much you spent today in buying the fruits. So you record it, and the way you record it doesn't need to be complicated. A simple notebook,
Yeah.
or a simple, if you are tech savvy, you can use a computer. A simple Excel can help you. So every time you buy something, every shilling that you spend, you record it down. And then every money that you sell, be it you've sold it in cash or you've sold it on credit, you also record it down. So once you've recorded it down, then at the end of the week or at the end of the month, then you can classify that. So if it's the expenses, you classify it into purchases, you classify it into transport, you classify it into salaries, you classify it into sales on credit, sales on cash. And then once you've classified it, then you can summarize it. You make a profit and loss so that you can know that you've made a profit or you've made a loss. So basically, that's how accounting will look like. But you start with recording, and then you don't discriminate the expenses that you're recording, because people will record the big expenses and forget the small expense. Maybe you have a small restaurant, umetuma mtu akaenda kanua kibiriti ya 10 bob ukasahau kurecord. And then now, due to the nature of the business, a 10 bob margin is a lot of money, kwa sababu for you to make a 10 bob lazima uze chapati tatu.
Yeah.
So if you don't record that 10 shilling you bought a matchbox with, then you've lost a sales of 3 chapatis.
Okay.
Yes.
And why is this kind of accounting important? Why is it important to put in place everything that you have just said now?
Okay, there are so many reasons.
Yeah.
Let's just start with the basic one. The basic one is you're keeping track of how your business is operating. So you're knowing that you're making money or you're not making money. That's the first step. The second step, you're ensuring that you're not missing your deadlines. Either you're collecting your money on time or you're paying your bills on time. Because if you don't record them, you will not know who owes you money or who you owe money. So that's the second step. The third step is, and which people maybe tend to forget and they fear the most, this is when it comes to the revenue man.
Yeah.
Because when KRA comes knocking, they are not going to rely on your memory. They are going to rely on what they can see.
Yeah.
And if they cannot see the supporting of a certain expenses, then that's a big mistake for you.
Yeah.
Because they are going to penalize you for that. And then they are going to penalize you, or they are going to use their means to tell you how much profit you made and how much taxes you're supposed to pay. And you will not have anything to defend yourself against. Then the third step is as businesses tend to grow, you tend to require financing. And when you need financing, maybe you approach a bank to give you a loan to expand your business, and bankers trust numbers. They don't trust stories. Ajaba have been making sales of 300,000. They want to see it. So once you keep that record, then it gives you credibility, even with lenders or investors, because there's something that they can look at.
Yeah.
Yeah.
And this record, how do you do it? Do you do it manually? Do you?
Okay. Yeah, it depends with the financial.
And talk to somebody who can be. Okay, so sorry. There are people who are able to employ accountants.
Yes.
And then Sakuna, those of us who've just started a business.
Yes.
Right? And we do not have the muscle to do that. So both sides.
Yes.
Both divides.
So we start with the common mwananchi.
Yes.
Allow me to call them that.
Please.
The mamambogas, the boda. You don't have money to employ an accountant. You don't have the technical know-how to operate maybe a simple Excel. So what you need is a simple notebook. Just buy a book. You can buy a counter book ile ya kawaida, ama chukua exercise book ya mtoto wako, because nowadays with CBC tunalazimishwa kununua vitabu vingi.
Too many.
They don't use all of those books in a year. So take one of those books. You can start from the front side, you record your sales.
Yeah.
From the back side, you record your expenses. And then at the end of the week, so that it doesn't become overwhelming for you, then you start summarizing it on a weekly basis. And you don't need to categorize the expenses, because since you don't know anything about accounting, you will not know what to put as admin expenses, what to put as operating expenses, what to put as other expenses. Just eka expenses zote pamoja. And then eka sales zote pamoja. At the end of the day, take your sales, less your expenses, you have your profit or you have your loss. But then as you grow and you start to understand, it might appear that you've made a loss, but in real sense, it's not a loss. Reason being is because you're starting small and you don't understand the accounting jargon, you're going to take everything that you've purchased and expense it in that week. But maybe after the week has ended, there are stocks that you purchased and you did not sell. So they're not supposed to reduce your sales. So now as you start to learn, you will know how to account for the closing stock, whereby now the closing stock, you're supposed to subtract it from your purchases. So maybe you've bought purchases of 100,000 in a week, and out of those 100,000 purchases, you still have stock worth 20,000. So it means whatever expenses you've incurred in your sales are not 100,000 but 80,000. So now as you get to understand that, then you'll know how to adjust for that. We call it getting the cost of sales. That's you take the opening stock, you add the purchases, then you less the closing stock. But before you get to understanding that technical bit of determining your cost of sales, just lump everything together, so that because you've recorded it, you're not able to lose it. And then another important thing with with these records, especially for people that deal with maybe perishable goods, or you have a shop na vitu zenye unauza ni ndogo ndogo mtu your employer can put in their pocket and go with it. It's important because you know how much you bought, how much you've sold, how much you should have in your shelf. So you can do a spot check. Kama ni kalamu, tumeuza kalamu 5, tulinunua kalamu 10, we are supposed to have 5 pens in the shelf, and you only have 2. And then you ask them, where did the 3 go? Then now they start telling you, I sold it to this, I forgot to record it. And then now you can look at your money and see, if you have excess, then they are telling you the truth. But if you don't have an excess, then they are lying to you.
Okay.
Yes.
Mimi nitazungumzia kwenye swala la cash flow. Are you allowed in any way to make projection?
Projection as in
ya pesa yenye nafanya biashara ambayo inaingiza pesa.
Correct.
So na ile mali ambayo niko nayo naweza nikakaa project kwamba hii mali ambayo niko nayo nafaa niingize kima fulani, pengine ni 300,000, ni 100,000 ama ni 150,000. Can I do that? And how can I monitor the cash flow?
Yeah, that one you're allowed to do it, but for budgeting and forecasting purposes. But awezi ukaitumia kumeka solid financial decision. Like you can say, for instance, that basically what you're talking about, we can call it the cash equivalent.
Okay.
This money that you have, which is not yet money, that you can easily convert it to money. And what you've spoken about, umeongelea mambo na stock. In ile mali yenye uko nayo kwa shelf. Yenye unajua unaweza ukauza in the next few days ukapata pesa, which can help you. Maybe you want to make a financial expenditure in the next 3 or 4 weeks. That is allowed. And another thing that you can also throw into that ni vitu tunaita debtors. Ni watu wenye umeuzia lakini hawaja kulipa. So hiyo pia inaweza ikaingia hapo. Umewapa wako na mali yako lakini hawajalipia mali yako. So you can do that, hiyo forecasting, but it's for budgeting purposes. But sometimes you also need, once you've done that, you also need to be aggressive. So kama umebudgetia pesa yenye iko kwa mteja wako haja kulipa, you need to be aggressive to collect it within that duration umepanga. And if you've budgeted for stocks that you've not already sold, you need to be aggressive in selling so that at least you don't get it wrong when now the suppliers come knocking, or now you need the money and you've not collected, then it's going to be difficult for you.
Well, kuna hizi vitu tunaita errors and some small thiefing.
Yes. Yeah.
Hizo era kidogo. Afu for example, let's mention what I'm conversant nayo ni biashara ya kuku ama mbuzi.
Okay.
Mbuzi atazaa.
Yes.
Sawa, lakini utafika watoto hawako. Ama mayai
hakuna.
Yanapuseti hakuna yako, lakini si ile idadi
ulikuwa unatarajia
yenye ambayo wewe unatarajia. Are there any measures zenye in terms of accounting na usilose pesa unaweza ukaeka kuhakikisha kwamba you control those small errors and some small thieving?
Basically your best friend will be your records. But now don't count your eggs your chicks before they hatch.
Okay.
So kama ni mayai yenye kukwasha taga umeka kwa basket, ayo ndo unahesabu. Lakini si ile una project kwamba niko na kuku 20 watataga mayai 20. Kuna mmoja ataenda tage kwa kichaka. Hiyo itapotea kweli. But you budget for what you ready. Kwa computer anasema what you see is what you get. So what you can see, that's what you budget for, but not what you are projecting, because hata kuku mwenyewe anaweza akagonjeka akakosa kutaga. So when it comes to stock, is what you have actually you've counted and you have it in shelf. Ama ni mayai si ya kuku, sasa umekaoda uletewe, that you are sure kwamba supplier atakuletea mayai 100. That's what you can record. But hizi zingine zenye bado ni work in progress, you categorize them kando kidogo. Yes.
All right, then we are speaking to Felix Birongo. He is a certified public accountant.
Yes.
And of course, we're looking at why proper accounting could save you money. Could save you money. If you have a question for us, 0700917917. When we get back, we would like to know a lot of things. And one of them is, what are the risks of poor or neglected accounting practices? So Felix, let's look at the risks of poor or neglected accounting practices.
Okay, thank you for that question, and it's a really good question, and which I can say is actually at the backbone of us having this discussion.
Yeah.
And one of the largest risk of poor accounting practices or neglecting accounting is missing tax compliance. Now that will arise because if you don't have proper financial records, two things might happen. One, you're going to file a wrong return because you're relying on guesswork.
Yes.
Or two, you are going to miss the deadline
Yes.
of filing the return, and that comes with fines and penalties. And depending on the nature of business, this because people normally think that filing the return only happens once a year, but there are those who are registered for VAT that have to file the return every month. There are those who are making profits, and their taxable their tax at the end of the year is more than 40,000. They're required to pay installment taxes every quarter. So that's one of the largest risks that you risk to encounter, that you're going to be non-compliant with the tax man. And then the other one of the other largest risk of poor financial practices or accounting practices is financial losses. So financial losses arise because you are not recording your expenses, or you're not recording your sales. You're not able to track where your money is coming from or where your money is going. So if you're doing that, then people might start stealing from you, because now, like the question that Salim asked, the only way he will know that he's expecting to get this number of eggs is because he has a system of accounting and recording those eggs. So if you're not able to account for that, you've not counted how many chicken you have or something like that, then it's going to be easy for you to keep track of that. And then if you're not recording your purchases and your sales, then it's difficult for you to know how much stock you've purchased, how much stock you've sold, and how much stock you should have in hand, so that now if your employees are stealing from you, then it's going to be easy for you to know that. That's the second one. The third one is what we call poor decision making. Because now basically when it comes to accounting, there's what we call management accounting. Now management accounting is preparing the financial statements for the purpose of management only. We call them the management accounts, which, depending on the nature of the business, you can do them on a monthly basis, you can do them on a quarterly basis, and then if it's for a small business owner, then you're supposed to do this on a daily or on a weekly basis. So it's going to help you, one, to see where you are making sales. Because now when you're doing sales, you have various products that you're selling. There are those fast-moving goods, there are those slow-moving goods, and then there are those seasonal goods. So if you have that management accounts, they are going to aid you in decision-making, so that you can know it's about time I stopped stocking this product because people are no longer buying it. That's the first thing. The second thing, when it comes to decision-making, you need to know where your money is leaking from, because there are those expenses that they are avoidable, but because you're not recording them, you cannot know them. And there are those expenses that maybe you are spending and you really don't know if you're spending money on that. So when you record that, and you don't just record, you review the records, then you are able to now determine and make the decision that we need to cut here, what they call austerity measures, that we need to reduce our expenditure on these things. It's about time we started laying off employees. If we are spending a lot of money on employees, it's about time we moved to a cheaper space. If you are spending a lot of money on rent, it's about time I hired an accountant. If I'm spending a lot of time keeping records, time that I would have used in the business itself. That's the third thing. Now the fourth thing is when it comes to accessing a facility, the financing facility or the credit facility, because the way I mentioned before, banks will not rely on your memory. They trust numbers, and these numbers come with what you can give them, and especially banks will ask you to give them audited financial accounts, and these audited financial accounts are going to be prepared based on your books of accounts. So if you don't have the books of accounts, then you're not able to get audited financial statements. If you can't get audited financial statements, then you can't get the credit facility that you're looking for. So what people do, those who are not keeping records, they will hire an accountant. Those who are lucky will be given a bank statement, and then you're told that ebu tengeneza vitabu from this. And there are those that don't even have a bank statement. And if they have a bank statement, imechanganyika personal money, imechanganyika business money, it's going to be difficult for the accountant to prepare that. So what the accountant will ask, and it's not advisable. It's not advisable. Ni ile tu mteja amekuja uko na njaa, unamwambia how much taxes do you want to pay? Nakwambia mimi nataka kulipa 1,000. So whatever figures they are going to put, they are not right. And then now what happens is, because these audited financial statements are going to be used for filing the tax return, they are going to be given to the banks if you need to access the facility. They are going to be given to governments or companies if you're doing tendering, because that's another time people require audited financial statements. They are going to be inaccurate. And if they're inaccurate, what happens a few years down the line, you're going to get a tax audit. So KRA will let you a notice letter. They tell you that we have an intention to carry out a tax audit from this date to this date. Kindly provide us with the following: audited financial statements for the last 5 years, bank statements for the last 5 years, supporting documents, that's sales invoices, purchases invoices for the last 5 years. Now, because you are not doing proper record keeping, you will not be able to get these things. So hapo ndio watu wanaanza kuogopa. Ukisikia KRA wanakuja, people start fearing, because you know what they're asking for, you don't have. And then if you prepared the financial statements, the audited financial statements from your guesswork, then they'll look at your bank statement. And when they look at your bank statement, they're going to do, if it's they take all the credits. So credits in the bank statement, that is money that has come into your business. And then they say that as per your bank statements in this year, the credits that you got were 3 million. So this 3 million, they'll do 30% of it after they've adjusted for expenses. They do 30% of it, and they tell you that the sales that you made was at 3 million, you need to pay taxes of 3 million. And because they have come after 5 years, whatever tax you were to pay 5 years ago is going to have interest at a rate of 1% per month for every month. So it's 5 years, those are 60 months, so it's 60% of whatever you were supposed to pay. And then now, because you don't have records, you cannot defend yourself. So you find maybe part of the money that has gone into your bank account was capital that you input into the business. But because your accountant did not factor that, you cannot defend yourself on that. Then another thing, you tell them that these payments were expenses that are incurred. Then they tell you, give us the receipts for this. You don't have the receipts. And then again, nowadays, they have what they call e-TIMS or TIMS compliant invoices. So if you don't have that, they do what is called they disallow it. So you find, because in accounting, the accounting profit and the tax profit are different, because there are expenses that will go to your profit and loss account, but they will not be factored in when you're doing your tax computation. And one of the expenses is expenses that are not properly or genuinely supported. So KRA will ask you for the receipts. You can't give them the receipts. You can't give them any because they tell you, okay, you can't get a receipt because you're buying from the market. Basi give us your purchases journal. Purchases journal is where you record your purchases every day, or the purchases ledger. Ukiwapatia counter book, they will accept that, because the law requires you that if you're putting your financial records, you put them in either Kiswahili ama English. So numbers, if it's figures, inasomeka Kiswahili ni 10 ama Kiingereza. 10 Kiswahili, 10 Kiingereza. So because you are not recording this, there's no way utajitetea. So
Okay.
that's the why it's those are the risks that you will incur if you neglect accounting or you do poor accounting practices.
I do have a follow-up on what you just said.
Yes.
And so now I want us to start with this person who's just registered their business.
Okay.
Okay.
Yes.
So I just registered my business,
Yes.
right? And when you do that, that means now you're starting to, probably you've seen clients and you're starting to get them on board, right?
Yes. Yes.
What should this person know? What are the measures that they should put in place?
Okay, so basically, when we talk about a relatively new business,
Yes.
it's good actually for a person who is starting their business now, because they are listening to this conversation, then they are going to avoid these mistakes
Yes.
that people make.
Yes.
So the first thing that you do before you start selling, the expenses that you've already incurred, like you're going to spend money to register a business name, or you're going to incorporate a company or register a partnership, whatever form of business you want to trade in.
Yeah.
It's important, actually, I mentioned, if you are starting to do business, just do a simple business name. It's going to say Salim Barisa trading as Salim Traders.
Yes.
So once you get that business name, it's going to help you to open a business account. For a sole proprietor, you're not going to get a separate PIN. It's going to be the same. It's just you,
Yes.
but trading in a certain name. So, but it will help you in getting a bank account that is specifically for your business. So once you have that, you start now recording your expenses, and then you be disciplined. One thing that people miss a lot, especially when you're starting your business, you're going to be careful in the first few months.
Yeah.
But after, say, 3 or 4, 5, 6 months down the line, unaacha kuweka records. So be disciplined and be consistent. So the moment you've decided that I'm starting a business, you register the business name. You can start without registering, because maybe you have how can I put it? You have a ready customer. Nile we labda umeanza kutengeneza hizi nguo za kucrochet na beshte yako ameona kwa nino, ameona umevaa kakwambia ulitoa mimi ndo nilicrochet.
Yeah.
Kwambia pia mimi nataka. You see, that's your first sale.
Yeah.
So you don't have time or money to register the business. So what do? You don't even need to go to the bank to open a separate bank account. Tumia simu yako M-Pesa, pochi la biashara, helps you to separate your business money and your personal money. So once you kept that money separate, and then you be disciplined, kwamba hii ni pochi la biashara, ni pesa nimeuza.
Yeah.
For me to get that money out, either I get it out as a salary,
Yes.
or I get it out kununua stock. But mtu atasema kwamba mimi hii pesa nimeuza, wacha niende ninunue uzi. Okay, but you don't already have another customer who wants to buy. Now if they want to buy, maybe the color of that thread yenye umenunua is not the color that they want. So don't make that mistake. If you've just started, don't be overwhelmed kwamba kila beshte yako anataka, and they've not even placed an order yet, but you are excited, ushanua stock, umejaza uzi, umejaza crochet.
Yes.
That's a mistake. Hiyo ndio ile yenye Barisa alikuwa anasema you project.
Yes.
But you're projecting wrongly. So if you're starting, it's the first important step is to separate your business money from your personal money. And then you record everything. Shindano utanua na shilingi 2. That's 2 bob is a lot of money. So you record it so that at least unajua kwamba hii pesa nimetumia kununua kitu fulani.
Yeah.
And then once you've done that, then you start, if the business keeps coming, then it's about time you register that trading name. Now registering a trading name will help you with the credibility that you are talking about, because there are opportunities that are going to arise that if you don't have that, you've not separated your money and you are not trading officially, then it's going to be difficult. And then now, as the time progresses and your business grows, then you can now consider you opening a space kwanza could display your products or something. And then but it's important to separate the business money from personal money.
Yeah.
And then it's also important to understand that you need to pay taxes on this money.
Also, why is it that, because you mentioned the E-Teams compliance, why is it that now KRA insists that you people, especially for I don't want to say that they're small businesses.
Yes.
I don't think it's just for small businesses that you have to have the e-teams invoice.
I think it's bringing sanity
Mm-hmm.
into the business world.
Okay.
Because you see, every organization tends to protect themselves.
Mm-hmm.
So basically what KRA is trying to do is ensuring, one, that whatever you are declaring as your business expenses is genuine business expenses. And then the way I put it ni kwamba KRA hizi kubali ukule pale hawajakula. So basically what it means, so whatever expenses you are using to reduce your profits for are sales for another company. So if that company has not declared that sale, then KRA hawatakubali wewe declare it as an expense. So that's where the e-teams compliant invoices comes. They are just ensuring kwamba whatever expenses businesses are incurring and claiming on their tax computation are genuine business expenses. And then they are also ensuring that now these genuine business expenses, they are expenses that have been taxed on the other side. That's why you will find that kitambo, things like donations were not allowable for tax purposes, because you'll find you've made a donation to a company that maybe is not a tax exempt. So if they are not tax exempt, then it means wao wamepata a benefit yenye ina reduce your taxable profit, but KRA is not getting anything on that. So that's why they brought that aspect of e-teams compliant. And then there's something that they call reverse invoicing when it comes to e-teams compliant. Kwamba if you are a business owner and you're dealing with small business owners who cannot give you a genuine e-teams compliant invoices, you can reverse invoice them so that at least wewe unapata genuine business expenses. But then again walikuja wakasema kwamba it's not all businesses that are required to be e-teams compliant. Our SMEs, small and micro, wao wanaruhusiwa kwamba at some point after people wali raise some issues, there are those that were exempted kwamba if your turnover less than 500,000 per annum, then it's not necessary for you to have that, but at least keep the records. But now with the e-teams, it's making it easy, actually, even in Asaidia, even the business owner, because if you're issuing the e-teams compliant invoices, that's one way of recording your sales. Because once you issue it, inaingia kwa servers za KRA, at the end of the month you can download a report ujue ni how much umeuza. Yes.
Okay, kuna vitu umevitaja hapo, audit report,
audited financial statement.
Yes, that one. Yeah, whatever ni vitu gani vingine ambavyo kwamba ni muhimu venye unafaa kuconsider kama hiyo story ya auditor, umesema nini unahitaji?
Audited financial statements.
Yes, that one.
Okay, actually realistically speaking, it's not mandatory for all businesses to have audited financial statements. Basically what it means, zenye ni lazima by law they have audited financial statements ni public companies. Now public companies, these are companies that are trading on the stock exchange. But for the private companies, na their share capital iko on a certain threshold, or even small business owners, you are not required to have audited financial statements. But the reason why it's advisable for you to have audited financial statements is kwa sababu the audit report will give you credibility. Because the audit report inakuwa guided by the Companies Act, na the auditor kazi yake ni one, confirm whether you've kept proper books of accounts. That's the first thing the auditor is supposed to do. So you give them your books of account, then wao ni kukwambia kwamba you've kept the proper books of account. That's the first step. The second step ni kusema kwamba the financial statements portray a true and fair view of the business operation. Sawa? That's the second one. The third one, because now utapata the business owner is not an accountant themselves, that when you give these books to be audited by a certified public accountant, yeye atakusaidia kukwambia kwamba hii ulifanya makosa. so that akwambie rekebisha hivi, rekebisha hivi, rekebisha vile. And then pia audit comes up with what we call the management letter of weaknesses. So the management letter of weaknesses is they will come to your business, they will ask you questions like kama ni sales, when you make a sale, what is supposed to happen. Nasema kwamba lazima mtu alete LPO, akishauziwa lazima delivery note ikue, invoice yatachiwe na pesa ilipwe kwa account. So utamwambia hivyo, hiyo ni internal control system. Hivyo ndio mambo yangu yanafaa yafanyike. So they are going to do a test of control. So they will take your records, they check kama LPO iko, they check kama delivery note iko, they check kama invoice iko, na they check if the money is in the account. And then once they've done that, then they will write a letter wakwambie kwamba hapa controls zilikuwa haziko, controls were missing, ama hapa the controls were being overridden, kwamba controls ziko lakini hazifuatiliziwi. So it's good that unafanya hiyo audit, although it's not required by law per se, but it helps you to identify those mistakes. And then the auditor will also help you with your tax computation. Atakwambia kwamba hii expense is not allowable for tax purposes, we are going to disallow it. If they do that, then you avoid a scenario whereby after a few years umefile return, then taxman akakuja akakwambia sasa hii return umefanya ni makosa, we are going to issue an additional assessment, and then they backdate it to when you ought to have corrected it. Yes, so
all right. And from your experience, Felix, what's the common financial mistake that you've seen that could be avoided with proper accounting?
I think the largest one is when it comes to tax compliance.
Okay.
I think that's the largest one.
That's the largest one.
Yes, tax compliance can, especially the fines and penalties, that can be avoided with proper financial accounting.
Yeah.
Then the second one is business collapse. Because you see businesses collapse even without the owner knowing that your business is collapsing. So when you do the proper financial accounting, then you will know if your business is a going concern or it's about to collapse, so that you can take corrective measures.
Yeah. How often then should businesses review their accounts to ensure compliance and accuracy?
I would say for small business owners, at least review them every week.
Oh, okay.
At least review them every week, because you see, you're the judge, jury, and execution in your business. And sometimes if you don't put that discipline of reviewing them on a weekly basis, you will get overwhelmed, because by reviewing them on a weekly basis, it's one way of training yourself to record them daily. Because if you don't record them daily, at the end of the week, you'll have nothing to review. So that's the important thing. And then for medium businesses, it's important to review them on a monthly basis. Now, reviewing them on a monthly basis is checking that we are making enough sales, we are collecting from our customers, because you're not just reviewing how much you've sold, you're not reviewing how much you've bought, you're also reviewing how much money you've sold on credit. Now, which are the long outstanding debts? Maybe somebody was supposed to pay you a month ago, it's 3 months down the line, they've not paid you. So by reviewing that, because you have everything, you have the debtors list, you have the creditors list, and then if you're using an accounting software, it will give you what we call the aged listing. So these are 30 days overdue, these are 60 days overdue, these are 180 days overdue, these are more than 180 days overdue. It's easy for you to know, now I need to start knocking on these doors, or I need to start paying these people. Yes.
There's a story that I was watching, a podcast that is the Financially Incorrect podcast, and there's a man who was talking about how there was, when we mentioned leakages earlier on, right? Yes, that he was losing money, but he did not know that his organization was losing money, right? How does a business owner ensure that such does not happen?
Okay, the best way of ensuring that you're not losing money is to put in place what we call the internal controls. So the internal controls, these are systems that the owner of a business or the management of a business are going to put in place, because you find that in a business setup, people are doing different things. So it's not easy for you to keep track of everything in one go. So when you put the controls in place, these controls are, let's say for instance, you've said that our controls when it comes to money is we do not accept cash payments. That's something that you've said. For our business,
Yeah.
this is our modus operandi. Kwamba this MO, how we operate, that we are not accepting cash.
Yeah.
So it's important for you to frequently assess if your employers are accepting cash payments. That's the first thing. And then if you are allowing cash payments and your system says that money must be banked on a daily basis. So you need to check on a daily basis and ensure that the money has been banked. And how do you ensure that? Unasema kwamba you deposit via M-Pesa and send me the message. Or deposit and send me, a slip. Or you go to the bank and keep an alert. Kwambia every time I get a credit in my account, send me a message. Na hawa wafanyikazi unawaambia kwamba every day I need a record of sales. How much you've sold, how much you've spent, and what is the closing stock. They take a picture and send it to you. Kama mko na group ya biashara mko nayo, wanaeka. And then so they say kwamba the cash that we collected today was 3,000. You expect before ulale, you get an alert at 3,000 in the bank account. So the best way ya ensure kwamba you are not losing money is internal controls.
Okay.
Yes, so you must have them in place.
And then also, how can business owners find trustworthy accountants? Because it's very, very important. Because these are people who handle your money, or even auditors to ensure accountability.
Accountant by virtue are trustworthy.
They are
By virtue.
okay.
But the thing is, you cannot get somebody who fits, like a nut that fits in all holes. So basically, it lies mainly on the business owner to ensure that in as much as you are looking for a trustworthy and a credible accountant, you've sealed all the loopholes.
Yeah.
And you'll find that in most cases, accountants will not handle your money. In most cases, they will not handle your money. It's just that actually they're the ones who will tell you that you're losing money here, you're losing money there. The people who are handling the money are the employees.
Yes.
So you'll find that maybe you have a cashier. So that cashier could be the one who is stealing, or the shopkeeper could be the one who is stealing. So the accountant will basically come and look at the records, and then they'll tell you that you've lost this much money, because they'll get your purchases invoices, they'll get your sales, and they'll do your stock take. So they tell you that based on our computation, you ought to have sold this much based on what stock you started with, how much stock you purchased, and what stock you're left in the shelves. And this is what you ought to have sold. But when we look at the bank account, this is how much you've collected, this is how much you have outstanding debtors, this is the variance, and this is how much either you've lost money or stock that was misappropriated by the employees. Yes.
All right. Thank you so much, Felix. It's been very educative.
Thank you.
And informative today. And of course, we do definitely enjoy listening to you.
Thank you so much.
Yes. We have been speaking to Felix Birongo. He's a certified public accountant. And of course, we're talking about how proper accounting can save you money. Okay. In case you missed parts of this, it's going to be on YouTube at Swahili Pods FM. We will be right back. Good morning.